Aloha, everybody. This is Tina Wildberger joining you today with four smart people to talk about some what can be pretty dry material. So I'm hoping to break it down a little bit for us lay folks. And we're going to be joined today by folks that are going to help us demystify the investment world. I'm going to define a few acronyms so that everybody is on the same page as we get started. Today, we're going to be discussing private equity, foreign investment in Hawaii, our state government retirement system, and how we can look at these and help shape a more circular economy that keeps investment in Hawaii benefiting our residents. First, we'll start back in the 70s. So this movement started as something called the socially responsible investing, or SRI. Investors use methods to exclude investments like guns, tobacco, gambling, and adult entertainment. Investing in these stocks was seen as supporting morally bad or socially irresponsible business. Fast forward 50 years later, this movement has evolved into something called ESG investing. ESG stands for three different risks. You have environmental risk, social risk, and governance risk. Environmental risk talks about businesses whose activities have actual potential negative impact on air, land, water, ecosystems, and human health. Social risks refer to impacts that companies can have on society. They're addressed by company social activities such as promoting health and safety. Governance risks concern the way companies are run. It addresses areas such as corporate brand independence, diversity, corporate risk management, and excessive executive compensation. The ERS is Hawaii's State Employees Retirement System. ERS stands for Employee Retirement System. It's our state pension package. I get a state paycheck now that I'm an elected official, and every paycheck I have deductions taken out on my behalf. Were I to qualify for tenure in the retirement system, I would receive a pension at the end of that retirement. It was founded, the ERS, in 1926. It has $17 billion in asset investment and a total membership of 140,000 current government employees and retirees. Of that 140,000, 50,000 are retirees benefiting from our ERS system. In May of 2018, our ERS signed on to something called the Principles of Responsible Investment. And that sign-on offers three commitments by our ERS. Our ERS is supposed to incorporate ESG issues, that means environmental, social, and governance issues, into investment analysis and decision-making processes, ownership policies, and practices. The ERS is also supposed to seek appropriate disclosure on ESG issues by entities in which they invest. And then they're also supposed to report on their activities back to the legislature about implementing those ESG principles. Today, we're going to be joined by Ian Chan Hodges, Imogen Rose-Smith, Delilah Rothenberg, and Jason Ward. We'll be discussing how public pension plans invest their money, particularly when it comes to private equity, the impact of private equity business model on workers and the economy, and private equity and tax avoidance. Some alternative models for private equity capital investment. We'll leave time at the end for dialogue and some case studies for discussion. First, I'd like to introduce Imogen Rose-Smith. She's a co-organizer for the Maui ESG project and the Ahupua'a Investment Summit, which was held here on Maui in January, just before COVID. Imogen has 15 years experience covering institutional asset management as a senior writer for Institutional Investor magazine. She was a 2017 to 2019 fellow at the University of California Regents, where she worked on ESG and sustainability issues. Her expertise include institutional investors, hedge funds, venture capital, impact investing, government policy, and long-term asset ownership. Imogen, can you provide an overview on how pension funds work and primarily how they make investment decisions, please?
Thank you, Representative Wildberger. I can try. I think you've already given a very good introduction So again, what we're really talking about here is defined benefit pension plans. And they are basically what they say on the tin. If you have a defined benefit pension, that means that when you're fully vested, you get a defined benefit, meaning that you are guaranteed a certain retirement payment in perpetuity, depending on what is negotiated in the union contract. So every state pension has a defined benefit pension plan, and a lot of municipalities do too. Obviously, in Hawaii, you have ERS, it's a $17 billion plan. And so pension plans have a pool of capital that they then pay out to beneficiaries. And that money comes from workers. It's money that's taken out of your wages. It comes from your employer. So your employer might be the state or it might be the county. And then it also comes from taxpayer dollars. So most pension plans, most public pension plans in the US are not fully funded, which meaning they don't have enough money to pay out all of the pension benefits that are needed. So I think ERS I looked it up the other day, but that might be a few years old now. It's somewhere that's like 54% funded, which means, were the pensions to be frozen tomorrow, it would only have 54% roughly of the funds that it needs to pay out pension beneficiaries. That's not necessarily a concern today because the pension isn't going to be turned off tomorrow, but it can become so somewhere like Puerto Rico, they have what is now called a pay-as-you-go system. They have no money in the system and they just have to pay out as they go along. The ways in which you can make that funding gap up is either through paying more into the system and or investment returns. And so that puts a huge amount of pressure on investment returns in order to help make that funding gap up and certainly not lose money. So the pool of capital that goes into the pension is then invested in various ways. Historically, those investments, back in the day, originally, those investments were probably just purely treasury assets. But more recently, sort of in the 80s, 90s, and many funds into the early 2000s, it would be a mixture of stocks and bonds. So it would be 60% equities, 40% bonds. And that's because bonds are considered low risk and equities is higher risk. And so that's how you got your returns. What started to happen after basically the sort of dot-com crash in 2001, which I'm dating myself now. So in the dot-com crash of 2001, there was this realization, we're overly allocated to what at the time was tech stocks. And so there was this realization on the part of institutional investors, including defined benefit pension plans, that they needed to what is called diversify into other types of asset classes. So those could be things like real estate, hedge funds, and in particular, private equity. So what you've seen happen again, sort of all across the country, is this shift away from a traditional stocks and bonds allocation to this increase in what is called alternative investments. And private equity has become a particularly popular alternative investment for people to invest in large part because it has had amongst the most attractive returns. And we're going to talk in a little bit as to why that is. So you've seen more and more money flow into alternative investments, more and more money flow into private equity. And what you've also seen is you've seen this money go to the largest private equity fund managers. So we're going to talk a little bit about Apollo and Blackstone, and those are amongst the largest, best known private equity managers in the world. So why is it that capital flows to these managers? In part, it's because they've historically had good to medium returns, but it's also because of their size. So, if your ERS is only 17 billion, but CalPERS, CalSTARS, a lot of the large public pension plans are ginormous. And it's hard for them to write checks for, say, $50 million. And they have an asset allocation, which is what this is, that tells them they have to have X percentage of their money invested in private equity. So they're constantly having to allocate more and more money to private equity. They don't want to they don't want to go with small managers because they don't want to be the biggest investor there. So the inclination is to keep giving money to these large private equity managers in order to fill their asset allocation demands, which they need to do in order to have the risk-adjusted returns that they need in order to continue to have the pool of capital needed to pay pension benefits. But investing in particular in something like private equity has real life consequences, right? You're investing in something and that is out in the world. So what you're seeing, for example, in Maui, is that a lot of these private equity managers who now have these big private equity funds that they're going out to invest are looking around trying to buy up assets to invest in. And again, because they have these big, multi-billion-dollar funds, they need the things that they invest in to be large. So something like, a hotel on Maui is a large investment that makes sense if you have a multi-billion-dollar private equity fund. So, and when they make those investments, they're trying to get the best return they can for their assets. So that might mean, for example, they're trying to do it in ways that are most advantageous from a tax perspective. They might, for example, be trying to invest in ways where they're not using organized labor because they know that they can lower their employment budget if they do it that way. So an investment like that can have mixed impacts on the community that it's invested in this case, Maui, right? So obviously if, Blackstone comes in and buys the Grand Wailea, that has certain benefits, right? So it's paying taxes, it's hiring people. Those investments, so ERS is invested in the Blackstone fund that is an investor in Grand Wailea. That investment, assuming it goes well, is going to have a direct benefit for the pension beneficiaries. But there are also potentially negative ramifications that we're going to talk about in a little bit. Was that a helpful sum? Was that clear? Do you have questions?
Yeah, that's great. It's great to understand how pension funds started out with their investing, but have evolved into a much different model of investing that includes big investment monsters that we don't know as much about. Thank you so much. Our next panelist is Delilah Rothenberg. She's the executive director of a company called PDI, or Pre-Distribution Initiative. PDI is a multi-stakeholder project to improve investment structures to share more economic information with workers and communities. The goal to create incentives for ESG integration and address systemic risks, including income inequality and climate change, including research on how to adequately compensate people for the value of created and risk taken throughout the capital market supply chain. Delilah, before we talk about Pre-Distribution Initiative's work, can you give us a short overview on private equity and why we as taxpayers, workers, and government entities need to understand this form of investment, please?
Sure. Thank you, Representative Wildberger, and thanks, Imogen, for the great introduction to this session. And thanks, everybody, for being here and organizing the event. So I'm going to share my screen, and hopefully this will work. Everybody can see my screen. So, why are we focusing on private equity, I think is one of the big questions before getting into exactly how it works. And we're focused on private equity partly because of the very acute impacts that Imogen mentioned, partly also because private equity is growing in the investment space as part of pension funds and other institutional investors' portfolios, and partly also because private equity firms have a larger and larger presence in the economy. So I'll just run through the writing on this slide so that you don't have to read it yourself, but public markets are shrinking. They're now less than half of their late 1990s peak and 25% smaller than in 1976. And you can see this corresponding graph here on the right-hand side of my screen, number of US public and private companies. And you can see that in 2000, the number of private equity owned companies, according to these estimates, and estimates do vary a little bit between firms, but this was taken from a presentation at a conference. It's very reputable, and the source is at the bottom. And these numbers are widely, roughly cited all over. But there were about 1,600 private equity owned firms in 2000. And you go to 2018 and you see that there are about 7,600. And at this point, we're talking about over 8,000 companies. And you can see how publicly listed companies in the dark blue at the bottom has shrunk by 36%, whereas the increase in privately owned companies by private equity firms has increased about 375%. So that's a very big difference. The bottom of that chart just shows the IPO count. IPO is companies going public, shrunk 63%. There are a lot of different reasons for this, whether it's because of institutional investors' appetite for higher yielding, higher risk return assets that Imogen talked about. So they have a lot of money that they're willing to put to work in private equity. Also, there are increased regulatory burdens for public companies. And so many argue that public companies prefer to stay private for longer. So lots of different reasons, but that's the way the investment universe and our economy is therefore also changing. In 2016, estimates showed that these companies employed about 11 million people in the US. As of 2017, the assets under management, that's the industry term for how much money these private equity firms manage, reached 5 trillion, which was the equivalent of 1/5 of the total value of the US stock market in that year. And as a more recent update, McKinsey estimates that as of 2019, private capital, which includes different types of what some people just term as private equity, there's private debt, there's venture capital, there's infrastructure, there's real estate, assets under management is about 6.5 trillion, an increase of over 4 trillion over the past 10 years. And estimates are that there's about 1.5 to 2.5 trillion dollars in what they call dry powder or uninvested capital. So that has yet to get into the system, and at which point there would be even greater private equity ownership of the economy. So that doesn't necessarily answer how does private equity work. I think Imogen touched on part of that question, which is, the institutional investors. There are other types of investors as well, but they invest into private equity firms, and then the private equity firms take that capital and they invest it into companies. And they typically will take about 3 years to invest the money that the institutional investors commit. So, ERS will commit $100 million, and a private equity firm to a private equity firm, and that private equity firm will over time draw down that money, go to ERS and say, okay, now we need another 10, now we need another 10, because we're, adding to our portfolio. And so companies are usually held for about 3 to 7 years on average. A fund's life is typically about 10 years, and sometimes they add on another year or two. There are increasingly longer dated fund lives, so 20 years, or what they call a permanent capital vehicle, where the fund is essentially could be structured as a holding company or an open-ended fund that continues. There are some benefits to that, which we can get into later. And then, the private equity firm, when it's holding these companies in its portfolio, it's supposed to work with them on operational improvements. There's a type of private equity or a style of private equity. It's not all of private equity, but it is a very dominant type, where the private equity firms will, when they acquire a company, use significant amounts of debt to acquire the portfolio company. And that debt is actually placed at the portfolio company level. So a company can become very indebted and have to service that debt, sometimes, not always, depending on how it's structured, at the expense of worker payrolls and benefits. And that has been an increasing concern to some stakeholders, particularly in the US. And sometimes the private equity firms will also have the company take out debt so that the company can pay dividends to the investors. And that can also significantly put the company in a precarious situation and stakeholders in a precarious situation. there should be, conceivably some operational improvements, like maybe the company becomes more efficient, or maybe it grows. But there are different strategies to generate returns, and some of them can be very detrimental and extract value from the company and hurt stakeholders, and some can really add value and grow the company and create good jobs and come up with innovative solutions and important goods and services for the economy. And so, during that value creation period that the company is in the portfolio, the company's value itself is supposedly grows, and then the private equity firm can sell that investment, whether it does an IPO, so it takes that company public on a stock exchange, or it can sell the company to another bigger company. That's called a strategic sale. It could sell the portfolio company also to another private equity owner, which has some issues and is increasingly common. But that's a little technical, so we won't get into that. Let me see. I think there's one more slide I'm supposed to talk about, and I probably went too long. Private equity is increasingly playing a significant role in essential goods and services and infrastructure and social infrastructure. So these are just some clips of, not to be overly negative on the type of investing in industry or asset class, as they call it, but it's important to highlight, why stakeholders are concerned. And so there are some concerns about private equity firms using those extractive practices where they extract value out of healthcare companies, out of elderly care companies, and that can really have a negative impact on patients. The quality of services can be impacted. It could be poor quality services, or there's a increasing awareness about the rise of surprise medical billing, for instance, where patients can be, there's a lot of price gouging and surprise billing going on that's unaffordable to patients. There's also been some concern about private equity buying available housing in the United States, and therefore pushing up the value of those homes and making them unaffordable to other people who, to everyday buyers who could really grow their wealth through investing in a normally priced home. The presence of private equity and the ability for them to invest hundreds of billions of dollars really makes these homes quite expensive, because it reduces the supply available to everybody else. And then if other people are dependent on renting from private equity firms, or private equity owned housing, then there are some situations that have been reported where private equity companies really aren't taking care of those houses, and they're charging all kinds of extra fees to the residents. And so it's a lot of different issues. So I'll pause there, and I hope that's helpful.
Thanks, Delilah. I think for me, as a layperson, the big takeaway is that we've had big changes in how our employees' monies are being invested, formerly in publicly traded companies with more accountability, now moving into private companies that are not publicly traded and lack transparency and accountability in their activities. And some of them are so big that we have a hard time grasping what they might be doing unless you're following them carefully.
Yeah. Yeah, absolutely. There, as Imogen mentioned in her initial comments, there is a trend toward ESG integration or ESG investing. And you also mentioned that in your comments, Representative Wildberger, which I was glad to hear about. I don't know, I have a few slides to go over in terms of what that actually looks like in practice. But Imogen, did you have any particular comments you wanted to make on that as well?
Yeah, I mean, I think we were going to go back into that in a little bit. I think, were we going to hear from?
Yeah, we're going to go to Jason, and then we're going to come back to.
So okay. We'll go into ESG in a second.
I think. Okay, our next presenter is Jason Ward. Jason has worked on strategies for organized labor in the past, including here in Hawaii. He's a principal analyst for the Center for International Corporate Tax Accountability and Research, an organization formed by unions and civil society groups that believe workers and the community need more and better information about tax arrangements of multinational corporations. Jason, your organization specifically addresses tax avoidance, something that should be very important to everyone working in government here in Hawaii these days. How has that impacted the investment practices of private equity, particularly when pension fund money is involved?
Well, I should just start by saying, I mean, tax is the basis for all of the public services that we as individuals and consumers rely upon. If people aren't paying their taxes, we can't pay for education, roads, parks, you name it. And so that's, and private equity tends to have a very aggressive approach to minimizing all its costs and, as was said before, extracting as much profit in the short term as possible. So I'll step back a little bit and say that the pension funds in general should be providing a positive influence on investment, because they are by their nature long-term investors, and shouldn't be seeking to sort of minimize, shouldn't be seeking to maximize short-term profits, but should have a long-term view that sort of can build money and build capital over time. The private equity model tends to rip out assets and rip out profits, and one of the ways of doing that is a lack of tax payments. So Delilah spoke previously about private equity firms using lots of debt. I'll give you one example of a private equity firm that has done that. I mean, they essentially took and operated a nursing home company, and the pension funds that were invested in that private equity fund were, the private firm was borrowing money at a 15% interest rate, which then eliminated all taxable profits. So here's a system that is based upon public funding to provide care for elders in nursing homes. And the company that's providing it, a private equity firm, is ripping out money from that system by and benefiting the sort of the pension funds that were partners in that private equity fund by charging incredibly high interest rates through debt to strip out operating profits. And so that's a very typical function of a private equity model. I'm a little bit south from you in Maui, and I'm here in Australia. I did, as was mentioned, work for Local 5 for about 5 years. And we dealt with a private equity firm on Oahu, that Oaktree Capital, a major private equity firm. And it refused to bargain with the union over wages and conditions. And basically, I mean, we partnered, obviously. We fought against that private equity firm as it was trying to strip out profits from the operating. But it's the main fight, and we allied with the community and with a group called Keep the Country Country. And they wanted to completely develop high-end condos and destroy Oahu's North Shore with, you know, just unnecessary and overdevelopment. And we engaged in a battle with Oaktree Capital, and one of the larger private equity firms, to stop that development. And
that was a very successful campaign.
Yeah, it was a good one, and we won in the end. I won't bore you with the details of what we did to them and the way we poked them around, but it did involve communicating with the pension fund owners who were invested in the funds. And it did involve making me spend a lot of money in Texas fighting our freedom of information requests. So there's been a big shift in pension funds around tax issues. The first time I started looking at tax issues with pension funds, we approached CalPERS, one of the largest in the US, around a tax issue. And they basically told us—
Wait a second, CalPERS, that is the California State Employees Retirement Fund, is that right?
The California Public Employees Retirement System, and it's the largest public pension fund in the United States, and you know, one of the top ones around the world. They basically told us, we presented to them the fact that their investment on property in the city of Houston was not paying the property income tax that it should be. And at that point, this was many, many years ago now, they told us to basically, you know, F off, we're not interested. That manager is doing what they should be by maximizing our returns. And now that pension fund has come around and understands that actually paying property tax supports the systems. And I'll give you another example of a campaign that I've run since being in Australia, but in California, where the San Diego County's employee retirement system was a partner in a fund, a property fund managed by JP Morgan Chase. And it owned a shopping center in San Diego County that was the largest commercial property in San Diego County. And it was paying half of the property tax that it should be. And so here you have a situation where the San Diego County employees who depend upon that tax revenue for their current livelihood are having their deferred wages and their retirement benefits used to undermine their current livelihood. That makes no sense whatsoever from the grand scheme of things and really needs to be addressed. One of the things that we did as SICTAR last year was we were able to mobilize global investors holding $10 trillion in assets under management to support transparency around tax payments. And that includes making the companies that they invest in report tax payments on a country by country basis in a public way. So I think that there are some positive shifts. There are some momentum that's moving in the right direction in terms of holding pension funds and their private equity managers accountable for you know, being responsible in terms of tax issues and funding the public services that we need. So there is progress there, and I mean, I think we can move to shape private equity in ways and pension fund investments more broadly in ways that actually do benefit society and produce the same returns over a longer period as well.
Thanks for sharing the real world on the ground implications of the sort of very ethereal sort of conceptualizing things we're talking about here and how it can affect people and organizations and municipalities on the ground. I feel like this movement is gaining steam and that it's in its infancy and that we can, with the right education, bring people along. Next, we're going to hear from Ian Chan Hodges. He's been working on social responsible investment for over 2 decades as a principal for responsible markets. Ian is a partner in the Maui ESG project and co-organizer of the Ahupua'a Investment Summit. Ian's going to shine a light on outside investors' role in Maui's economy and politics. Ian, many people in Maui County may not realize the impacts that outside owners, including private equity funds, have on our day-to-day lives. Can you explain some of the current ownership structures of our hotels, perhaps in my district in South Maui, and how that relates to what the previous panelists have been talking about, please?
Absolutely. Thanks, Representative. And thanks everybody for participating, both the panelists and the attendees we have. I'm going to share my screen really quickly here. So this here is actually, and again, Representative Wildberger represents South Maui, and this is an example of hotel ownership in South Maui for 4 hotels. I'm going to get to the private equity one last, down there at the Grand Wailea. But the first one is the Andaz and the Fairmont Kealani. Both of those hotels are owned by Host Hotels and Resorts, which is actually a real estate investment trust that's publicly traded. The largest lodging REIT, the acronym is pronounced REIT, in the world. They have, like I said, 2 hotels. One, the Andaz, that's represented by the Alda View, is the union representation, and the other one, the Fairmont Kealani, which does not have union representation. I'll actually get back to that in a second. But one of the things that I wanted to address, since we're talking about tax issues, is how REITs are actually taxed. And for the past, I believe it's been about 7 years, the Hawaii legislature has been trying to work on getting bills passed that would actually tax REITs more. Right now, it's a little complicated actually how it works, but basically REITs just, they take their profits out of the state and they're not taxed. And the latest bill, Senate Bill 2697, was passed by the Senate just before the COVID shutdown in March. And that would have disallowed dividends paid for deductions for real estate investment trusts for 3 years. And what in that bill, what the state Senate found was that real estate investment trusts have about approximately $17 billion of assets in Hawaii. And pre-pandemic, they made about $1 billion in profit, which would have translated into about $65 million a year in taxes for the state. Obviously, I would think it's pretty easy to guess that they make a little bit less now in the pandemic. The other hotel that I'll actually talk about is owned by MSD Capital, which is Michael Dell, who's a billionaire who started Dell Computer. It's his family office, which basically means the $16 billion that his family has is their own personal wealth, owns the hotel. And again, that hotel does not have union representation, has about 1,000 employees, smaller than one of the biggest hotels out there, just smaller than Grand Wailea. The interesting thing about MSD Capital, they are a family office, and we do have quite a number of billionaires who've invested in Hawaii directly. One of them, Larry Ellison, who's a little bit richer than Michael Dell, bought the island of Lanai, which has 2 hotels on it. And there is a little bit of a difference with if you have ownership by someone where there's one individual who has the power of the investment. In Larry Ellison's case, he actually did decide to continue to pay workers over there who are all represented by LW, continue to pay them even after pandemic shutdown of the tourism industry. Then we get to Blackstone that we've talked a lot about. Blackstone is the largest private equity firm in the world. They own the Grand Wailea, which is also the single largest private sector employer on Maui. Grand Wailea is represented by the LW. And a lot of the issues that both Jason, Delilah, and Imogen have brought up about private equity definitely apply here. They paid a number of years ago when they acquired the Grand Wailea, they paid the second largest price ever paid for a hotel in US history, $1.1 billion. And also, as any private equity deal, most of them are highly leveraged with debt. So that's also an issue. But I think one of the things that's important to keep in mind is that when we're looking at who employers are on Maui and who owns our hotels, and Maui is very dependent on the tourism industry, and one of the reasons why we have the highest unemployment rate in the country over the summer, and it's still very high. We need to actually look at what the ownership structure is. And so you look at, what what people are paying in taxes. And one other thing that I'd mentioned about Blackstone, because I already talked about the taxes with the REITs with Andaz and Firma Kealani, is that Blackstone's managing partner who actually runs the LLC that owns the Grand Wailea, his expertise is not in hotels or things like that. His expertise is actually in taxes. So it gives you an idea that they do actually, they're paying attention to what taxes they pay, and that's part of the way they structure deals. And the final comment I'll make is it is important. Hawaii is the state with the most unionized employees in the country. And there is a big difference if a hotel is actually unionized. There's a number of different advantages to that. One of them is clearly the unions can negotiate for better wages and benefits. And the second one is even the non-unionized hotels, like we have the 2 ones here on the list, the workers there will also benefit because the union workers actually raise the sort of prevailing wage of what is required to pay people. And the final point I'll make is that and this is definitely become very clear during COVID, is unionized employees tend to be able to whistleblow more because they can actually go to their union, and that can become very important to keep track of which hotels are really following COVID procedures and protocols and which ones aren't. So anyway, that's a basic overview of the ownership structure in Representative Wildberger's district. And I think it's important that we keep on top of what the ownership structure is so we know who owns our productive assets in Maui. Thanks, Representative.
Thanks, Ian. Glad you're bringing up REITs, the Real Estate Investment Trust entities that are investing in properties largely in Hawaii because they are not taxed at all. My first session at the state legislature, a bill that would tax REITs made it all the way through our legislative process, all the way to the governor's desk, only to be vetoed, sadly. So maybe that's something that we'll be able to reconsider given our deficit of tax income this year. Thank you very much, everybody, for all of this incredibly great information about local and global economic realities. Since you're all working to address these challenges in somewhat different ways, I'd like to focus on what we as taxpayers, legislators, workers, and beneficiaries can do to try to ensure that our investments, values, and shared prosperity are aligned. Jason, you've been working on a campaign that directly impacts the Canadian Pension Fund that also is known, also now Maui's largest private landowner, PSP, also known here on Maui as Mahi Pono. Can you tell us about the Canadian workers' concerns about their own PSP investments in elder care facilities in Canada and the campaign to hold them more accountable, please?
Thank you, Representative. Yes, I'm working very closely with the Canadian unions who are deeply concerned about PSP's, one of PSP's largest investments. So PSP has taken out the private equity middle managers and essentially acts as a private equity firm itself. PSP is the pension fund for Canadian federal workers, and it has close to $170 billion in assets, $170 billion in assets. It directly owns a company in Canada known as Revera. And Revera is the second largest nursing home senior housing company in Canada and is now facing major class action lawsuits because people may not realize this, but Canada has had the highest rate of COVID deaths in nursing homes than any country in the world. And the unions are campaigning now broadly to bring back the operations of nursing home away from for-profit companies and back into public control. And specifically, those unions whose money is invested in this company are now campaigning to basically, so their campaign is called Make Revera Public, and they're looking to essentially bring back control of this company into public hands so that it's not driven by the motive of maximizing as much profit as possible by understaffing and overcharging residents, which and that is the cause of the COVID deaths, right? COVID exposed an underlying problem of gross understaffing across the whole sector, and people are dying not directly from COVID because the understaffing has permitted the virus to spread uncontrollably in their facilities. And even this company, I think it was last week, their facility in Winnipeg in the province of Manitoba, I think something close to 50 people died in the span of 2 weeks. So studies have been done in Canada, studies have been done in Australia that show when these facilities are run by government entities, the results are different. If there's an infection, it stays with one person and people have the staffing capacity, resources, equipment needed to deal with it properly. Whereas when you have a private equity mentality running those companies, people are dying left and right. And obviously that's happening throughout the mainland United States as well. It's a huge problem in Canada. So I just want to kind of come back to the particular aspects. They're running this campaign in Canada, and the work that I'm doing is in support of that. But what I'm doing is looking at this company, Revera's investments, because Revera is the #2 company in the sector in Canada. Its top competitors are publicly listed companies, one of them being a REIT, a real estate investment trust. And we can find out information about those companies because they have to report to shareholders. Revera, there's no information on its operations available in Canada. There's no information available in PSP's annual report other than to say this is a really big investment that we have. And so what I've done is I've looked at this company, Rivera's investments in the UK, where private companies are required to file annual financial reports. And its partner in investments both in Canada and in the UK is the third largest real estate investment trust in the United States. It's a company now called Welltower, and it's the largest owner of sort of senior housing assets in the world. And I can tell from Welltower's filings that it's making a killing, literally, on its care home investments in the United Kingdom, in England. But I can tell from the filings of the Rivera-controlled operating companies that all of those companies are reporting a loss. So what this tells me is that this is a clear case of tax avoidance by a public pension fund and a REIT who should be liable to be paying taxes on their UK investments. What happens in Canada is a different story. But they've structured this business so that the money paid by the operating companies is going to the real estate owned companies in the tax havens of Luxembourg, Jersey, and Guernsey. And at the end of the day, the public funded healthcare system, which the residents in the homes that they rely on, who are paying 200 British pounds a day to have the privilege to be in those homes, but is underpinned by a public health system. So here there are, essentially a fund with 170 billion Canadian dollars in assets is ripping out funding from a public health program and making profits that are tax-free in the place where those profits are earned. So we're using this story to expose the broader problem about how Canadian pension funds work as direct private equity players. So the last thing I'll say about PSP is that in addition to owning the water rights on Maui, they are the largest owner of water rights in Australia. And Australia is sort of, we almost burnt down last year with the incredible bushfires here. We're at the front lines of climate change. It's a dry climate, and the water rights being extracted are leaving everybody in jeopardy. And so indigenous people, small farmers are getting screwed because somebody has decided to commodify water rights and look at extracting as much profit from that as they possibly can. So I'll stop there.
Wow, that is some scary stuff as we contextualize what you've shared with us with the fact that Maui's only healthcare facility has been taken out of state direction and offered to an hard to understand business arrangement between, again, private enterprise and Kaiser. It sounds like these issues have similar considerations that privatizing our PRISM system has, and we need to consider what kind of services our tax dollars are going to pay for if somebody's going to profit from them. Maybe these functions need to remain in-house under the municipality. I'm going to switch up to Imogen again. Imogen, I understand our pension funds in the US seem to have more transparency and accountability than pension funds do in Canada. In spite of signing on to environmental, social, and corporate governance principles, ESG, pension funds like ours, the ERS, the Employee Retirement System, still invests in fossil fuels, in Blackstone, and even in Apollo, a private equity fund which has ties to the infamous Jeffrey Epstein. Going forward, what do you think pension funds like Hawaii's ERS could do proactively to avoid investments that are not aligned with our own stated principles and our beneficiaries' values?
It's a good question, but it's a tough question to answer, right? It's obviously important, and I think clear from what we've discussed already, to understand that ESG isn't sort of the cure-all for this problem. I think when we were holding our summit on Maui back in January, there was actually a lot of skepticism, and Ian can attest to this in the work that he and Shay have been doing with the community subsequently. There was a lot of skepticism as to sort of what ESG meant. And I think there's good reason for that, which we'll get into in a second. But, and it's also important to understand, so why is this happening? It's not that your investment office is sitting there and being like, hey, let's go and find the most evil investments we possibly can, and let's do that, right? So, investors at public pension plans and other fiduciaries have what is known as a fiduciary responsibility, meaning a legal responsibility to invest the money prudently and with care. So they're going out and they're trying to find the best investments that they believe are out there to invest this pension money in, right? They're trying to do their job. But what is happening, and what Jason in particular is speaking to, and you're going to be mad at me now because I'm going to use a technical term, but it's effectively a massive tax arbitrage, right? That you don't want to be seen to be paying a lot of money into the pension systems because, as I was saying, they're underfunded. So you try and make the money up through investments, but especially in this low interest rate environment, a lot of the times the way that you're making that money is through financial engineering, i.e. not paying taxes. So the trade, if you like, is between the taxes that you're not paying into the system versus the taxes that are not being paid by the investment. And that balance is sort of the financial return that's going to pay the pension beneficiaries, but it's also going to do stuff like pay Leon Black his, big annual check that he then turns around to his, good buddy Jeff Epstein and says, hey, Jeff, how do I spend less in taxes? So that is sort of the cycle. What you can, and it's very hard, the other thing to understand is that once the pension plan has invested with in particular private equity manager, because these are long-term funds, it's very hard to do much about it, right? The rules of the road are set in place when you make that investment. You can sell the fund on what is known as a secondary market, but you're probably highly unlikely to do that. So if, for example, you find out, hey, my private equity fund is investing in for-profit prisons, and your beneficiaries start getting upset about that, there's not really much that the pension plan can do at that point. So, what you can do though is really be clear about trying to set the rules of the road up when you go into investing. So, when we're talking about ESG, say pension beneficiaries can say, we don't want our pension plans to invest in fossil fuels. We don't want our pension plans to be doing certain things. But then what you need to do is be very clear about following up and demanding transparency and accountability. What you're seeing is a lot of pension plans sign up to the PRI, say, yeah, sure, this sounds great, but not necessarily sort of following through in terms of their investing. So they might say, we don't want to invest in fossil fuels, but then you actually find out, well, in their private equity investments, they're investing in fracking in Texas. So, the difference between here and Canada is that we do have a fair amount of transparency into what our pension plans are doing. If you go onto the ERS website, you can see all the funds that they're invested in. And, if you've got a spare couple of days, you can kind of dig into, okay, what are these funds actually doing? So it is possible to have a fair amount of transparency, and then you can ask questions and you can hold these funds accountable. And you could also think about, for example, putting certain clauses into investment contracts, saying, for example, that if what's known as sort of the key man, the principal person in an investment fund is found to be hanging out with Jeff Epstein and involved in sex trafficking, then that is sufficient cause to break that contract and we'd like our money back. Putting in place those kind of structures could potentially help investors have more control. And some Taft-Hartley pension plans do put in place, hey, we want you to use union employees. It is possible to do that, but it requires stakeholders to push back, and it requires the investment office to be willing and able to push back, and often they're not. And so that potentially is where legislation can play a role. But I think Delilah has her slides on ESG, which will also give a little bit more color into what ESG investing means. And the important thing as well, I think, about ESG, as Delilah sets up her slides, is that it's important to think about who is defining ESG. So PSP, for example, is saying very clearly the Mahi Pomo investment that they're investing in, they think is a fantastic ESG investment. They have it on their website as an example of the best ESG investing they could possibly do. They've given the team an internal award for having made such a great ESG investment. Well, I actually don't know why, but they gave them an internal award. They think it's a great ESG investment. And from their perspective, it might look like that. You know, I think many people in Maui and in the community have a different perspective. And so I think something that really needs to happen in the ESG community is we need to do a better job of giving a voice to the community and identifying sort of who defines ESG. And actually, and I think Delilah's work also speaks to that a little bit. So, Delilah.
Wow, you can really see how there's an awful lot of activity happening at a higher level that's not involved with the people whose actual funds are going into these investments. And so we need oversight, and we need folks like you doing this good work to bring light to it. Delilah, what is your perspective on these issues? Please tell us more about what your organization has been doing to restructure private equity and its practices, please.
Sure. I'm not going to use slides because I realize that we're getting short on time, but I do think that I agree with all of the comments made. What we're working on at the Pre-Distribution Initiative is having worked in the ESG space in private equity and having seen how it's actually implemented and integrated, and having participated in the field building of, you know, creating best practices and implementing them. I think we've done a lot of great work, but there are some challenges that are preventing us from really measuring and managing some of the issues that came up on this call today. And that's what we're focused on. A lot of the ESG approaches to measuring and managing negative impacts is really focused on portfolio company operations. But there's also the way we structure the investments and the investment practices that really sets the tone for how the company actually manages its operations. And so it's very difficult to have a responsibly run company when, as Imogen said, the investors are under so much pressure to squeeze out returns from these investments in a low interest rate environment. And so we're really looking at how can we restructure these investments to be more regenerative. How can asset owners and allocators look at their portfolio construction or asset allocation, as Imogen showed, you know, how much is allocated to super high risk, high return investments like private equity or high yield bonds or leverage loans or CLOs. Like these are very risky investments that, you know, historically have produced stronger returns than other asset classes. But those returns are starting to get harder and harder to come by, and yet we're still having more and more risk. And it's not just the investors who are taking the risk, it's all these other stakeholders, as you've heard. And so how can we rethink, you know, what we're investing in, how we're structuring it, you know, I think we're at time. So I invite you all to visit our website, predistributioninitiative.org, to learn more and stay in touch.
It's such important work, and it's a groundbreaking sector, right? You've come out of traditional investing and moving into this new view of investing and how we can be more sustainable in all those three risk categories: environmental, social, and governance. Thank you so much for sharing. Ian, your current project focuses on capital deployment for community need in Maui County. Given what we've heard about all the challenges and potential solutions, what would you like to add to this discussion today?
Thanks, Representative. I just put up a slide here that we've been talking about PSP a lot in Mahi Pono, but I wanted to use that as an example. And again, Jason talked about working with the Canadian unions, and their PSP is, they're the beneficiaries of, Canadian federal workers are beneficiaries of PSP's pension fund. And going back to investment in Maui, we have a situation over the last couple of years where with PSP coming into Maui and acquiring the former A and B lands and also working on getting the water rights, we have a situation where our largest private landowner and our largest private employer are both private equity funds. So it's one of the reasons why we've been focusing on this, because it does have a big impact on our community. And if you look at this chart here, there was, from my understanding of the investment, PSP actually allocated and committed $600 million towards the Maui investment. And of that, about half has been spent already. And basically, as was mentioned before, PSP, for the most part, acts as if it basically operates as if it's a private equity fund with this type of investment. So unlike the ARS, which does invest in Blackstone and other private equity firms, they're one of many public employee pension funds and other sort of institutional investors that invest. In this case, all the money, or almost nearly 100% of the money coming in to acquire the A and B lands, which is now known as Mahi Pono, comes from PSP. I think one of the things that we want to be able to look at as far as Maui is concerned, and a number of people mentioned the low interest rate environment. So, interest rates are some of the lowest they've been in history. And so what ends up happening is, from the point of view of private equity, since they do rely on a lot of debt, they are in a situation where they can, load up on cheap debt, make these acquisitions. As was mentioned before, they have a lot of dry powder. They have over $1 trillion ready to invest. And I think that's also a concern for Maui and Hawaii, is because you have this capital waiting. If there's failures of other hotel companies, the private equity is not done with Maui or with Hawaii. The basic thing that I think we should look at is the question of, in a low interest rate environment, isn't there a way that we as a community can actually lead these investments ourselves? If you have low interest rates and you have the ability to sort of float green bonds through municipal finance, et cetera, what actually are we getting as a community from the introduction of private equity capital? And what are the benefits and what are the disadvantages of it? I think, one of the areas that's important to look at, that's a critically important issue from the point of view of PSP and Mahi Pono, is water. And as Jason mentioned, water, PSP is acquiring water rights in Australia and is one of the largest rights holders in Australia. What's happening here in Hawaii is that we're basically, in a lot of ways, subsidizing what Mahi Pono and PSP want to do. We basically have the situation where last Friday, the Board of Land and Natural Resources unanimously agreed to extend the water lease for about 45 million gallons a day of water out of East Maui to a partnership called East Maui Irrigation. That's a joint partnership between PSP, Mahi Pono, and Alexander Baldwin. And the rates they provided that water are far under the rates that farmers pay, a fraction of it. So basically, the state, by doing that, is subsidizing PSP, Mahi Pono, probably between about $9 to $15 million a year. And that's money that's not going to the state coffers. The other issue is that we have had with Alexander and Baldwin, with sugar workers, for a significant amount of time, Hawaii and Maui in particular, with sugar workers represented by LWU, had some of the highest paid agricultural workers in the world. And that's something that looks like it is not going to be continuing with Mahi Pono, although that's still up to, see what happens with that. But basically, what we need to look at is, when we're talking about investing in different assets, when we have a low interest rate environment, are the ways that we as a community can actually lead these investments. That doesn't mean we can't bring in other investors, but can we actually lead these investments using municipal finance? and basically, acquiring assets for the benefit of our local people. And one final thing I'll mention about this is what ends up happening also with private equity and other forms of investors. They do spend a lot of money on lobbying and kind of political influence. So that tends to distort the system. And if that's kind of your investment game plan, where you're using your money to kind of change the rules or bend the rules towards your advantage, it doesn't really mean that you're a better business operator. It just means, you're trying to game the system. And so one of the reasons when we talk about ESG, we talk about E as environment, S is the social side of it, which includes employees and all the other types of issues that impact us on a community level. There's also the governance issue of being able to have more accountability and more transparency about what's going on with investments. And I think that's very important for us as a community in Maui, for Hawaii as a whole, and for the world, actually. So that's kind of the overview, and using PSP and the Canadian Pension Fund as an example.
Thanks, Ian. That's really up close and personal, close to home example of this kinds of things we're talking about. If Delilah doesn't mind, I'd love to go back and see those slides. We do have plenty of time. But first, I'd like to remind our audience that you can ask questions in our Q&A on this broadcast, in the webinar, or if you are watching us on Facebook, please go to Chan Hodges' original share on this presentation, and you can ask. We have Natalia Hussey-Burdick, the inimitable NHB, on that Facebook thread looking for questions if you'd like to have somebody expound on a question you might have. So please take it away, Delilah.
Okay, thanks again. Might be obvious. I didn't realize we were going a bit longer. So yeah, I mean, I think that I will share my screen again and just provide some more concrete explanation of what ESG traditionally looks like in the investment process. And we can then go into why there might be some of these blind spots that we're talking about, where these issues just aren't really captured. So when a private equity firm integrates ESG in the investment process, we're looking at this diagram at the top of the screen, this chevron. So there's a screening phase where they find some investments that they're interested in, or an investment. They do some high-level due diligence on it. They should be screening for, red flags. Then they do more significant due diligence. So, some examples of red flags are they might be investing into a factory and there's a really bad health and safety record. There are high incidents. There might be unhappy workers. So if that's the case, there are issues that are fixable and addressable. If you invest into the company and you have influence over the company once it's in your portfolio. And so you might say, okay, this is an opportunity to take over this company and make workers super happy and, reduce the incident rate and pay them better. Or it might be a situation where a red flag is that you're building a power plant on a sacred site, and that's something that's not really fixable, right? So you might not want to do that project at all. And so, you have to make an investment decision. And if there are gaps that can be closed and issues that can be measured and managed, then you put together a action plan with targeted timelines to close those gaps. You figure out how much it's going to cost you as a private equity firm. You figure out how much value you're going to add, how long everything's going to take. You might integrate some of the plans into the incentive agreements with the executives who run the company, and maybe put some requirements to close gaps in documentation, legal documentation if you can. And then they're in your portfolio. You monitor, evaluate, you work with the company to improve. There's a bunch of other stuff that you do, as you mentioned earlier, when a company's in your portfolio, and then you exit. I should say during the monitoring and evaluation stage, in terms of what is required in an ESG context, there are lots of different frameworks out there that provide you with metrics against which you can measure and manage E, S, or G issues. And so you should have your portfolio companies reporting to you on progress. You should be working with them on setting targets for progress. And then when you sell the company, you know, there's an ongoing debate. There's a lot of issues around, well, what happens if you sell the company to an irresponsible investor and they're the highest bidder for that company? You know, that's maximizing the financial return, but you might have a mission drift, or you might be resulting in negative impacts for those stakeholders. And as Imogen mentioned, you know, there's a strong interpretation of fiduciary duty for private equity firms and their investors of maximizing financial return, regardless of environmental and social impacts. And so, you know, unfortunately, I think there's a lot of pressure for private equity firms to sell to the highest bidder. And this should all be documented in a management system. There should be policies and procedures for each stage of the investment process. The ESG management system, looking at this gray chevron now, you know, it should be evaluated regularly for improvement, and there should be stakeholder engagement in terms of what are the right policies and procedures we're having. Are we doing a good job? Firms should have a mechanism so that stakeholders can get in touch with them, both at the private equity firm level and at the portfolio company level. Investment professionals and ESG professionals should be evaluated based on similar performance metrics. Unfortunately, some of the metrics that are most frequently used to measure private equity performance or basically have this concept that you want to make as much money back as fast as possible. That's called the time value of money. And that is for a number of reasons. It has to do with the investor's opportunity cost and the reinvestment rate. But if you want to make as much money back as fast as possible, and also part of that metric is you want to spend as little as possible early in the investment stage. And if you can imagine, you know, an infrastructure project or something, that's when it's so critical to engage communities. That might require some additional costs and extra time. That can really put a drag on the valuation metric called IRR that investors use to measure investments and that investment professionals are measured against. So, you know, that really, there's a lot of opportunity to reevaluate how investments are actually measured from a financial performance point of view. There should be senior management endorsement and support of the plan, appropriate resources to implement the plan, transparency and accountability, reporting out to stakeholders on the plan and what can improve. And this last point I already mentioned. I think we can skip this slide. I know we want to leave some time for questions, and I already integrated this information into what I've previously said, but one thing that we might want to highlight is just what are the KPIs, how are they tracked and reported through the company to senior management and to the board and stakeholders and potentially other stakeholders. So what are we thinking about at the pre-distribution initiative in terms of adjusting the private equity model? We can probably already guess a few things from the comments that I just made about the IRR metric and time value of money. Private equity has a lot of good potential. So growth equity can lead to job creation and economic growth. As I mentioned before, investors can take control positions in companies, and so they actually have a big opportunity to push the company to make positive changes. And then private equity investors typically have a longer time horizon than public equity investors or investors in stocks, for instance. So you might frequently hear about people complaining that the stock market investors are so short-termist, and you know they might be trading in and out of stocks on a quarterly basis or maybe an annual basis, while private equity investors are invested for multiple years. One might justifiably argue that a 3 to 7 year time horizon isn't enough. We would encourage private equity firms to extend their time horizons, but extending a time horizon can lead to more opportunity for long-term sustainable outlooks. And really, one other thing about the investors into private equity, particularly pension funds and other types of institutional investors, many of them have liabilities that they need to pay out several decades from the time of investing. And so they say that they have long-term time horizons in terms of when they need to realize their returns. But sometimes the investments themselves just aren't really structured that way. So there's a lot of opportunity to change that. There's also potential in the way private equity firms invest for them to come up with creative financing. So for instance, private equity executives, private equity professionals are rewarded or paid by the investors with management fee, an annual percentage of the assets that are invested into the fund, as well as some of the profits from the portfolio companies. And so could there be potential for profit sharing with workers in the portfolio companies? Could there be worker ownership programs with workers own some of the equity in the portfolio companies? This is a more technical, we won't get into revenue-based financing and equity redemptions, but there are more flexible investment models for slower growing companies and smaller companies, longer dated funds we want to develop, and then really narrowing the fund manager to average worker compensation ratios, which is part of what we're thinking about in terms of profit sharing. Private equity executives make significant amounts of money. There's a lot of concern about paying executives to $1 million a year on average. So,
Delilah, we've got you breaking up really badly. I don't know if it's a connection or a mic issue. Is your mic okay? Sorry to interrupt you.
no worries.
Oh, that's better. That's better.
It is.
Go with
I
that.
don't think I did anything though.
Okay.
Do you think is it still working, or should we move on?
It's all good now. Yeah, it's all good. Whatever.
Okay, great. So
Now it's static again. I think it seems to work when you lean in more. I don't know.
Can you hear me now?
Yes.
So some of the executives of the largest private equity managers making.
Oh, Delilah, I'm so sorry. We've got such bad static. We can't make out your words. When you ask if you can hear us, we hear it perfectly. And then when you start talking, it goes crazy. Okay, so we're going to go ahead and move on to questions. I'm not sure who wants to take this first question. I think for Ian, perhaps, from Kamalani. She asks, what kind of public company ownership structure would you envision to take over fallow-claimed Maui Pono farmlands and East Maui irrigation?
Sure, I can take that. Thanks, Representative. So basically, there's a couple of different ways this can be done. One way is we could actually look at Hawaii has what's called the Sustainable Business Corporation Law. So if it wanted to be sort of a private sector but public purpose entity, that could actually be used. And what that does is it requires a corporation under that statute to not only consider shareholder interests, but also the interests of the community, employees, the environment, that sort of thing. So that's one of the approaches. Another approach could be to look at creating a special purpose government entity that actually would have a community board to be able to do that. There's a number of different kind of structures we could use to be able to have ownership of the EMI system. So that's a basic answer. There's a lot more detail to that, but those are two answers. One is sort of a private sector approach where you utilize what we already have in the statute with the Sustainable Business Corporation. The other would be sort of a special purpose public sector ownership.
Great, thanks for that. Next, we have a question, let's see, from Heidi to all panelists. So whoever wants to take this one. How does Maui's bond rating relate to possible investments from ESG funds? And how do community workforce development projects get supported in the mix?
I can take a crack at the bond rating part of this. I'm not going to do the community workforce development part of this because I'm not knowledgeable enough. That's almost a Shay question, I think. But you know, municipal bonds are a very interesting space right now from an ESG investment perspective. I think you're seeing a lot of interest on the part of investment managers and allocators in doing sort of green municipal bond investments and finding opportunities to do ESG investments that support municipal projects. So I think there's, again, Ian was talking about possible structures for EMI, and you could certainly see a scenario whereby raising some kind of municipal bond could be very attractive to the investment community. And clearly, you know, Maui's bond rating would help with that. The caveat to that, of course, is that, so on the one hand, it's a very attractive environment for raising municipal debt, you know, again, in large part because interest rates are so low. On the other hand, you know, Maui and everywhere else around the country is going to struggle with revenues as a result of COVID-19. So you have this tension between, oh, it would be a great opportunity to do all of these things, and they would in turn create jobs and result in ESG investment, et cetera, et cetera, et cetera. And there's a market for them. And the immediate economic impacts and the crises caused by COVID-19. I don't know if anyone else has anything they want to add to that.
Anybody want to add to that?
Well, I can add something really quickly, Representative Imogen. The other thing to look at, and Imogen mentioned the you know, tax revenues. We do actually have, as far as Maui County is concerned, we do have very low property taxes, and there is a structure in place now, put in place by the county council, where people who own second and third homes here can be taxed at a different rate. So there's some room to sort of increase revenues in Maui County without impacting local residents that could be put into, you know, making payments on bonds.
Awesome, thanks. We have got a question from Lindy Bacchus for Delilah. In the ESG investment process slide, you list the bullet points, investment professional and other team member performance tied to ESG metrics and appropriate resources as uncommon. Are these gaps you think that should be prioritized since they are presently uncommonly emphasized? The first point could also be a focus, but you say that one is becoming increasingly common.
Yeah, I hope that everybody can hear me now. Great. I do think that that those should be prioritized, and there is an effort by organizations like the Principles for Responsible Investment to ask fund managers when they do their annual reporting how they're integrating ESG, to talk about how investment teams and professionals are incentivized to degrade ESG. So that's really nice and a step in the right direction. I'm not sure if there's been official reported data on that, but from being active in the industry, it doesn't seem like, it seems like there's a lot of improvement. It's early stages for those kind of structures. And then in terms of appropriate resources, yeah, absolutely. I think that if one were to go to a private equity firm and say you need to resource this appropriately, they'd probably be like, well, aren't we already have an ESG professional? But really the ESG professional needs to be given the budget and the other human resources that it needs to really integrate ESG well, and that's a more complex and nuanced issue. The last thing I'd say, on the first point on that slide where it talked about there should be an ESG management system for it, the point said, and I skipped over this, both the portfolio company level and the fund manager level. And so when we talk about things like whether the fund itself is domiciled in a tax haven, that's not covered by existing ESG and tech frameworks. Those focus on the portfolio companies themselves. When we talk about what's the fund manager doing in terms of lobbying and political spend, that's not captured by existing ESG and impact frameworks, impact investing frameworks. That's really a question that is increasingly asked of portfolio companies, but not necessarily of the fund managers. The fund managers, you know, when it comes to appropriate leverage thresholds and uses of leverage in a portfolio company acquisition generating returns, that's not measured in an ESG context. And when we talk about how much the fund managers make, I understand that it was hard for me before when I was making this point, but private equity executives are some of the best paid executives of any industry, making, for the mega fund managers, hundreds of millions of dollars a year. And people are concerned about banking executives who are making roughly $30 million a year. So, you know, let's not only look at what we can do at the portfolio company level to pay a living wage, to generate some wealth for workers, but we also need to look at how much the fund managers are making, because if their rate of wealth is growing at an exponentially faster rate than workers in or beneficiaries of the portfolio companies, then we're going to have systemic wealth inequality just growing, and that really needs to change. So, can we measure the executives in the private equity firms? Can we measure the pay ratios between the average worker and the portfolio companies and the executives of the private equity firms, not just the executive in the portfolio company with the workers in the portfolio company?
Thanks for that. We've got a question from Ivan Ho. Delilah noted in a slide that ESG commitment is currently uncommon. Pension fund investment managers usually say they can't or won't take sides when an ESG concern is brought in front of them because it falls outside of their fiduciary duty. An easy excuse for them to use when there's no need for ESG compliance. So it appears pushing pushing pension funds to commit to ESG is the first step for broad pension fund and private equity reform. What is ESG trend in pension fund world now?
That's a really great question. When we started at the pre-distribution initiative, thinking that we would work with fund managers to change how they structure investments in their funds, and we thought we'd go to the investors in the private equity funds, like the pension funds and so forth, to encourage them to push the fund managers to change. We learned pretty quickly that it's hard for the pension funds to push their preferred private equity funds to change. And as Imogen mentioned, there's a tendency for these large institutional investors to have to invest in the largest fund managers, and part of that has to do with size. Part of it has to do with the career risk of the investment professionals. There's the saying, nobody ever got fired for hiring IBM or McKinsey. It's similar with a Blackstone or a KKR or a Carlyle. But these funds are oversubscribed. Everybody wants to get into them. And so if you're a pension fund and you push your fund manager too hard and you want them to do something that they're not willing to do, they're going to say, well, sorry, everybody, I got a huge line of people at my door who want to get into this fund, so I don't need your money. And that's a concern. And so there's a real need, absolutely, to work with these investors to think through how they're constructing their portfolios and to support them in engaging with their fund managers to to change.
Thanks, Delilah. I'd like to turn back to Jason and see if he has any wrap-up remarks to share.
Yeah, I mean, I think just in response to that question there, I mean, I think it's up to us as members of the community, as people who have influence over, you know, pension funds, unions, the community at large, that these ESG issues need to be translated into economic terms as well. I mean, obviously we're coming at them from the pure ESG issues, but at the end of the day, these investments are going to fail and the beneficiaries are going to fail unless the broader community interest is taken into account. I mean, we have to sort of push them to have that long-term view and to have a view that takes into account all of the different factors of that investment, including the environmental sustainability, worker pay. I mean, if to take ERS in Hawaii as an example, I mean, it's the benefits that workers pay, that they get paid now and that they get in their retirement that is much more sustainable to the long-term benefit of the Hawaiian economy than what Blackstone is able to rip out of it at this point in time. So I think we need to think about this in ways that influence the long-term thinking of pension funds and the private equity firms, investment managers as a whole, and make sure that they're understanding that these broader issues actually will have a financial impact on those investments in the long term.
Well, after learning about all of these important issues as it relates to how investments are made here in our community, what exposure we have related to them, you all sharing these solutions and how we can improve how billions of dollars are invested here in Hawaii. We can take away, we can all go back, and if we don't happen to have a pension fund, we can go look at our 401ks or our Roth IRAs and take a look at the funds that we're invested in and see if we see anything that we don't like. This has been a really great discussion. I appreciate everyone's contributions and time today. I learned a lot. I hope that everyone viewing on Zoom and on Facebook also found this very educational and useful information that we can move forward. I know that in my work, I'll be able to, as the vice chair of the new government reform committee, I'm interested in working on all kinds of things. So I'd like to thank Ian Chan Hodges, Imogen Rose-Smith, Delilah Rothenberg, and Jason Ward for joining us today. I'd also like to thank Natalia Hussey-Burdick and Shay Chan Hodges for their backup. And thank everyone who joined us today. Look forward to doing something like this again. I learn a lot when I join you smart folks. And we'll say ahui ho for now. Thanks a lot. Aloha.